Get in Jyotivardhan Jaipuria from Valentis Advisor. So, firstly, to start off with mid-cap and small-cap valuations, if you look at the 12-month forward valuation for mid-cap stands at around 33, 34 times. For small-cap, it's around 21, 22 times. This is the highest valuations that we have seen if we remove the COVID period. So, don't you think now at least the valuations are too expensive even when we compare it with the large-cap space?
Yeah, so like you said, the large caps probably trade at around 22 times 1 year forward. The small cap is trading at around 20 odd times 1 year forward, and the mid caps as well, probably the valuations are the most extreme at over 30 times. So two things are there. Obviously, they look high, and so you want to buy these at little lower valuation. The only thing which is against that is the growth in the small cap and mid cap has been much higher than the growth in the large cap companies. And going forward, also, at least if you take very consensus analyst forecast today, the growth in the small and mid cap is much higher than what the growth forecast is for the large cap companies. So on a very broad brush, the analysts are forecasting next 2 year earnings growth for the Nifty, or you could take that as a proxy for the large cap at around 12%, and they're looking at growth for the small cap indices at around 20%, and for the mid cap indices around 15%. So if these growth forecasts hold, then there's some justification for little higher valuation. Though in general, I would say, yeah, the valuations have become quite extreme for some of these spaces.
Agreed that growth is higher when it comes to mid and small cap space, but that has been the case always. But don't you think these valuations are too extreme, and do they look sustainable now?
So I don't think these valuations will sustain. The issue just is if we get that sort of growth, it's like, if you get, let's say, a very broad brush 20% sort of growth in the small cap index companies. And if they grow at, if the share price goes up by 10%, you end up, getting valuations which are 10% lower. So to that extent, it is more like, do we really get that sort of growth coming? And probably the return in the stock prices are going to be lower than the return in the earnings growth. So that will compress the valuation to some extent. I think we will get some price corrections along the way also. And this would be true for the large cap, small cap, and the mid cap, because, if we just go back, it's been a long time since we had a 10% correction in the market. And, a 10% correction is now. If you think of the last 25 calendar years, there have been only 3 years where we've not had a 10% correction in a calendar year. So I think, yeah, to some extent, markets are not cheap. They are pricey. We will get some price correction, hopefully, and we'll get some time correction along the way, which is required to make valuations a little more reasonable.
Yeah, but we all do suffer from the recency bias, and as you said, last 3 years there hasn't been a sharp decline post that COVID time. Perhaps that is what we remember so far. But just wanted to put the spotlight on some of these new age tech companies, and I'm talking about a policy bazaar which has been on a declining trend for the last couple of days. Ease My Trip, of course, is a bit of a reaction to the large trade that has happened on that one. What do you make of some of these new age tech companies, even throw in a Paytm and Zomato for the works?
So, we generally have not been participating in some of these. We like to have visible growth, and we are very, very valuation conscious. So to that extent, we are very light in our exposure to a lot of these new age tech companies. For me, it is, where, like, we've been discussing valuations. So if we go deeper into the companies, there's quite a bit of valuation disparity. We've been trying to hunt for companies where valuations are relatively cheaper. Like if you think of our whole portfolio, today our portfolio trades at 115 time 1 year forward. So in some sense, though the market is expensive, we try to keep our portfolio at reasonable valuations, because as and when the correction comes, you probably have corrections which are more in some of these companies where the valuations are relatively much more expensive.
Jyoti, the new take which a lot of fund managers are taking right now is the cash call, and that's become the big debate. How are you looking at it? Is it probably prudent to have some powder dry on the sidelines, or there is a risk of missing out another rally?
So, there has been a risk, and if we just rewind back 6 months ago, or at the beginning of this year, most people were cautious for this year. Everybody thought 24 this, and this included us. We thought it'll be a year where we'll make a single-digit return in the market. So we've generally we've had cash, which is around 13% of the portfolio. and we are taking that cash call and we are sticking to it. There is a risk that on that cash you'll underperform a bit if the market continues to go up. But you want to keep some powder dry, because if you get a correction and you don't have money at that time, then it's not great. So very often, you keep cash for 4 5 months and, you lose out on it, but then you get one bout of correction. And then that cash really helps you, because in the next leg of the rally, you make a lot of money in the stocks you bought at low prices. So yeah, I would say we are more than normal cash. We're sitting at somewhere 10 to 13% sort of cash across portfolios.
This 10 to 13% cash that you have is actually more than what the average mutual fund cash holding is at around 5 odd percent. By when do you plan to deploy this, and which are the sectors that you think are attractive enough and you can deploy the cash in these?
Yeah, so like, I guess, to be fair, we are a PMS, so we have a lot more flexibility than probably what the mutual funds have. And for us, the cash is not, because in a PMS you run portfolios which are very, very distinct. So it's not like we have 13% cash across portfolios. But to some extent, I guess the flexibility is much more than what the mutual funds have. Our thought would be, to wait for corrections. And where we are deploying is we are trying to look at, so we have a philosophy which we follow, which is called the 3Us. So we do undervalued stocks which are underperforming and underowned. So most of the time we are looking for, spaces which is, relatively less valued, which is out of favor at the moment, and where we think the long-term prospects can change. So, at this time we've been buying actually the banks. Banks is one space which has done badly. There's obviously NIM pressure, and so nobody likes the banks at this stage. But ours is, the valuations have become cheap. It's actually probably the only sector where, if you look at valuation today versus a 10-year average valuations, banks today trade lower than the 10-year valuations. So to that extent, a lot of the bad news is getting priced in the stocks. There'll probably be 6 months, it may or may not perform. But for us, we've started buying the banks, and our ideas over the next 6 months, we'll keep adding to the banks.
Comes to banks, where is your focus? Is it the private banks or the PSU banks?
So, generally, like, when we think about it, we don't really distinguish banks between private and public that much. We think of, corporate banks and retail banks. So even now, there are like smaller private sector banks which probably are trading at valuations which are cheaper than what a lot of the public sector banks are trading, or the larger private sector banks are trading. So this is, one area which we've been buying at. And the other is, of course, the large private sector banks are also looking very reasonably valued at the moment.
Certain financials are looking reasonably valued, but would you extend that argument to certain IT names also? And what about pharma?
So Pharma is another pocket which we like. Pharma we've been playing for the last 18 months, and we like it because of two things. So one is, what's happening in the US is, there was a constant price fall in the US generic space. And this has been like a last 6 7 year phenomena. That price fall has probably eased off quite a bit. Prices are now plateauing. Mind you, they're not going up, but they're plateauing. So all the, pressure with the bank companies were having is eased off quite a bit. Second is, the crime space is looking very interesting, and you have the Biosecure Act, which is, hopefully getting passed sometime next year in the US. So all of those will help Indian crime companies. So for us, it is crimes is one space in pharma we're very bullish on. The other is companies which are geared to the US generic market.
Well, thank you, sir, for joining us and for giving us all those details, and for putting things into perspective.
If you like this video, then like, share and subscribe to ET Now.